Hi Tushar, how are you?
Oh, Madhur, welcome. I'm good. How are you doing?
I'm good, I'm good. Sorry, मेरा थोड़ा ही glitch था यहाँ पे. It was not connecting somehow. So,
कोई बात नहीं सर.
thank you very much for joining and give us the time. I believe these students from IIM Vizag will learn a lot from your expertise and knowledge that you have it, right? So, thank you very much for joining in. Karan, anybody else will be joining in, or we can start it up? Let me know.
We can start, Madhur.
All right, sir. How are you, sir?
Very good, excellent. So I was saying that because the placement activity is going on in the college, so students are also late, Madhur is also late, so we are aligned. So there is no issue in delay. So thank you very much for joining in, and thank you Tushar for taking out time to discuss and deliberate upon this investment banking opportunity for the students. As I mentioned, that these are the students from IIM Visakhapatnam, and they are very keen to learn about this investment banking, particularly as a career opportunity. So that's how Madhur and I we are helping them to learn more about that opportunity, and so that they can decide in future what which kind of career path they want to take. So over to you, Madhur.
Thank you,
You,
sir.
sir, for setting the tone. So, hi guys, my name is Madhur. I run startupnews.fii. We are one of the leading startup communities in India, and we do a lot in terms of startup ecosystem back here in India and in multiple countries. Today we have got Tushar. So Tushar runs consultancy ventures. He works very closely with a lot of startups who are looking for debt fundraise, venture fundraise, even SME IPO. I really wanted to learn a lot, from him about SME IPO. I'm more active onto the venture side. Um, and he's super active on LinkedIn and participate in a lot of podcasts, right? So you can check out Tushar's LinkedIn profile also. You can learn a lot, from his wisdom. So thank you very much, Tushar. Thank you very much for giving us time.
You're welcome.
So, I mean,
I'm
to start with, I believe I have not shared much about consultancy ventures. I really would like you to first share it. Um, uh, what is consultancy ventures? Because this will set the tone of the investment banking, and then we'll move towards, the topic of today, which is more of a SME IPO thing, which is very interesting. Somebody who wants to jump into the investment banking.
So Consultancy Ventures is a network of investors. The venture capital investors, almost all the active ones in India, and including a large part from Singapore, Dubai, US, and UK. And apart from venture capital funding, we help startups and growth stage companies by way of SME IPO. We are the partner for the largest anchor investor in SME IPO space, Rajasthan Global Securities and LRSD Securities, having invested in 115 IPOs with assets under management of 18,000 crore. And we do a lot of debt also, primarily unsecured debt, which is needed by companies, because a lot of startups don't have real estate to give to the bank. So we do a lot of unsecured debt to help them.
Wow. So, let's start again, from basic, because these students probably don't might not have much idea about the SME IPO and the things that we're going to talk about this thing. But let's first understand the very basic difference that you feel like between the startups and the SMEs. Like, how do you define a startup and how do you define an SME?
A startup is a company which is scalability oriented, which tries to disrupt existing business models, which believes that they have something new for the customer, and they are willing to bet a huge amount of money in pursuit of that customer, even if it means catching the customer first, but earning from the customer later. I say this with a pinch of salt that already, although unit economics and profitability are very much demanded by venture capital funds, but But a lot of these startups, they don't have any other option but to catch the customer first, by way of subsidizing, by way of making the product or service supremely attractive, and then later on monetizing it. SMEs are stable mid-market kind of companies, which are in kind of boring sectors with very boring business models like manufacturing, steel manufacturing, trading, and just to give you a sense, the number of startups listed with the Startup India scheme of the government of India is almost 1 lakh 60 or 70,000, whereas the number of SMEs in India are 6.2 crore. And in terms of jobs, startups provide jobs to 20 to 30 lakh people, but SMEs provide job to almost uh, 15 crore people. And there are other differences, like startups are able to get hold of the hot money, which is chasing risky returns, but exponential returns, but risk returns. But SMEs, they largely get access to debt from the banks, from the formal channels, the NBFCs, the banks, and they don't have access to this kind of hot money. But things have changed. In 2024, almost 240 SMEs raised 8,753 crores from SME IPO. So now SMEs also have access to money on the balance sheet, and not only money which is expensive and which doesn't allow them to grow.
So interestingly, so you said SMEs, it's sort of a boring business, right? But I believe these are the guys, these are the this is the sector, or this is the industry where majority of the fund and majority of the employment comes from, right? Though it is uh, tough, though it is probably not so cool as the startups ecosystem or startup founders and things like that. But we've got Haldirams and we've got Pepsi, we've got all these bigger corporates with us. So coming to again the topic. Uh, one more basic question, and then we'll jump into understanding more of the SME IPO thing, right? Just share us, what are the different options of funding, when we talk about startups or when we talk about SMEs, right? What are the different ways that a startup can raise the funds and an SME can raise the funds?
Yeah, that's a good question. So a startup can raise the funds initially from friends and family, people who believe in those people. They trust and believe in the person. I remember I was a shark at Shark Tank India, and one of the guys went to Lucknow, his hometown, and came back with 4 blank checks because he shared an idea with his mother, who shared with the relatives. So that is one, friends and family. Second is an angel investor. There are a lot of angel investors now. Like, people want to invest in startups. The whole field has opened up. Shark Tank has given a lot of exposure to common people, even to housewives, to industrialists, to people who are on a job. And then the Startup India scheme is also there, where there are 500 incubators with the different educational institutions, and out of these 500, 100 are active, and the government gives grants as well, 20 lakhs, 25 lakhs, and initial seed money, 20 lakhs, 30, 40 lakhs. Unfortunately, in India, at the early stage, debt is not available. It can only be taken through private sources, like somebody known to you gives you 20 lakh and says that return it back to me with interest. So something like that is possible. Then you have accelerators and incubators. We have more than 1,000 accelerators in India. and T-Hub, or T-Hub is an incubator, like GSF Academy and India Accelerator. So they um, they have a network of angels with them. So they work like an angel network, like FARD network, or V Founder Circle, or Real Time Angel Fund, or so Real Time Angel Fund is a VC. So they provide funding through the network, and they help you with things like co-working space, Wi-Fi, CA, CS, legal services. So they assist you in all these ways, and of course, they take an equity for that. And then you have VC funds, which typically invest not in very small amounts, but minimum of 1 crore, 2 crore. You have micro VC funds also, which invest small amounts. I saw a list of active micro VC funds in India, and it was 65, and they all were super active. So you have micro VC funds, and then you have VC funds who invest in larger amounts, like pre-Series A, Series A, Series B, C, and then as you grow bigger, you have private equity funds who invest in 100 millions and 200 millions. And then you go forward, you have the ones who invest in companies like Byju's, endowment funds, university funds, pension funds. Then there is no end to it. There are sovereign funds, the sovereign fund of the Middle East, the Oman, Qatar, Temasek, the sovereign fund of Singapore. It has assets under management of more than $1 trillion. So this is the these are the options for startups. For SMEs, it's traditionally has been promoter funding, that the director in the private limited company gives a loan, and then when the company earns back, he takes back his loan, and that has been the traditional route. Uh, and now, in a lot of SMEs, family offices have interest, because suppose a family office is of a corporate which is into a particular sector. Now they would want to invest in the similar type of companies who are in that sector, so that they not only benefit from the return generated on the investment, but they also bring synergies between the investee company and their original corporate. So that is why family offices, they are active in SME and startup space both. They are active in both spaces, and they do a lot of strategic plays also. Many of them believe that it is very difficult to generate return in a startup industry, so they need control. So many of those, they actually invest more than 50%. But there are others who are investing minority also. In SMEs, so debt is the primary way it has been funded till now, and promoter loans. But now we are having SME IPO. So any company with a turnover of minimum 10 crores, ideally it should be more than 30 crores, and a net profit. Net profit, again, because the valuation in the SME IPO is driven by profits. So ideally, the net profit of the SME should be a minimum of 4 to 5 crores for the valuation to be decent and the IPO size to be decent. So that is one very, very attractive space which has opened up, and and we are investing there as the largest investor, but we are also partnering with the big SME IPO anchor investors like Mr. Sunil Sanghania, Mr. Ashish Kacholia. Like we brought Morgan Stanley Singapore in the Oriana Power deal. So we are collaborating in IPOs. People always collaborate. You don't take the entire risk. This is true for startup funding also. The VC funds, they always believe that they don't want to put the entire check, and they should always pool the money so that the risk is diversified. And the same thing happens in SME IPO space, and a lot of investors, they come together, and when one investor is putting his foot inside the door, the other investors feel that there is a validation that this heavy investor is backing this deal. So he must have done the due diligence, seen the promoter, has trust on the promoter, and hence we can also get in. So it works like that.
So, so there are a lot of we've been getting into the news of there are a lot of startups also jumping into the SME IPO lately, right? Just couple of things. One is what are the things that a startup can get out of doing an SME IPO, like about 30 crores or 10 crores or 30 crores worth of the revenue? Or, just comparing it or talking about it, why not to raise a VC next round, right? So typically benefits of getting into the, SME IPO.
See, look at it this way. You, first of all SMEs are not eligible to get venture capital funding. I think 90% of the SME businesses will not qualify. And the VC will say it is not scalable, it does not have potential to explode, and it does not have potential to go viral on the, using technology. So most of the VCs will not touch it. Um, but if you compare, a venture capitalist does have some ways in which they protect themselves, and one is they might take an observer position on the board of directors. Second, they might take a seat on the board of directors, or they can have a nominee director on the seat of directors on the board of directors. So apart from the equity they are taking, they are also wanting to have certain compliance which protects them. And if you look at their shareholders agreement, it has a huge number of clauses which protects them. If you look at the shareholder agreement, which is there on the Startup India website, the sample agreements, the whole bunch they have, which is very fine agreement. It has clauses like, in the annexures, you can put in all the scenarios in which you have to take approval of the venture capital person before making a decision. Like, you are recruiting a heavy salaried CXO, or you are divesting a huge asset, or you are suddenly, entering a new market. Uh, so, all these things, they have uh, they have a right. What I mean to say is they have a right to say no. And this is not true. This is not true of SME IPO. In SME IPO, what happens is that almost 30% of your shares they get listed on the exchange, and in return, those retail investors they are only protected by SEBI and the exchanges. They don't have any control on your board. It is, although you disclose how will you use the funds, and you have to follow it, like the purpose of raising the funds, there are guidelines of SEBI which tell you that how much you can use for general corporate purposes. You can't use beyond this number, beyond this percentage, to repay back the promoter loans. So you have guidelines for each thing, but there is no investor sitting on your head. There is no investor sitting on your board. In that sense, it is largely more freedom you have. But at the same time, because you are a listed company, each action of yours is watched. So some independent director leaves the company, you have to inform the exchange, and it will definitely come in the paper. So your every action is watched. There are research reports which get put out on your company's performance. Your financial performance is out there for everyone to have a look, because they form a part of the disclosures. And in the draft red herring prospectus and the red herring prospectus, which is filed with SEBI, it is such a huge document, almost 300 to 600 pages, which gives each and every aspect of the business, all the court cases, all the sensitivities and the weaknesses and the downsides possible. So the information is out there. So you have, from earlier you were just caring about your stakeholders, which were your customers and employees. Now you have an additional stakeholder, which is the retail investor, who's watching you day in and day out. And when it comes to the size of it, the IPO happens on a valuation which is a multiple of the profit, net profit. Suppose a company has a 50 crore turnover and a 5 crore net profit. So the valuation of the company will be 10 times net profit, 50 crore valuation, 30% of the companies will be listed on the stock exchange. So the IPO size will be 15 crores. And out of that 15 crores, it might happen that the merchant banker's fee will be deducted, which fees is usually 8 to 16% for good companies, and for bad companies like cash flow problem companies like real estate, almost 30 to 35% success fee. So that money is deducted and the balance amount comes to the SME's account.
So, very interesting, insight that we're getting out of, this conversation about SMEs. What are the how do you select a company? I would say a startup, like I would say a company. I think one thing that is shared that it has to be a profitable company and it has to be 10 crores to about 30 crores of revenue. What else? Like, what are the things that probably negative things that that comes into the picture that this company can't apply for SME IPO, right? And or probably what are the things that needs to be there, if an investment banker is looking at a company, that out of these five files that I have quoted, out of these five companies that I have it, these two companies only are primarily eligible for this, and documentation is a separate thing, but primarily eligible. So how do an investment banker selects that this could be good for an SME IPO?
Madhur, just like when you take a loan from a bank, so you have to meet the criteria of the bank, the RBI criteria, that you should have enough cash flows to service the loan. And in terms of non-serving of the loan, you should give some collateral in case it is a secured loan. In case of SEBI, we have very, very firm, written in black and white guidelines, like the company should be minimum 3 years incorporated, 3 years of minimum incorporation. It should have net tangible assets of minimum 3 crores. It should have a post-issue paid-up capital of less than 25 crores. The promoter of the company should not be have ever been involved in a criminal case. And so all these things, and now they keep on adding to it. Like SEBI has added that the company should have a minimum operating profit, EBITDA, of 1 crore in one out of the preceding 3 years. And it should have a profit in minimum 2 out of the preceding 3 years. So all these things, they are the first line of understanding whether this company can come out with an IPO or not. Then you have things like that. You have things like what was the question? Whether the trust-based thing. So there are two ways in which a SME founder is very typical. It is a very typical behavior of a SME founder. One is they always work on thin margins. Like SMEs are always, there are so many SMEs, they are competing with each other, and the promoter feels that why should he pay tax? So at the time when he is doing his accounts, he will always show almost nil tax. 97% of the 6.2 crore SMEs don't pay tax. So what they do is they don't show profit, and this is to avoid tax. And the second thing they do is that after they get listed, at the time they are getting listed, they start showing profit. So SEBI has become very, very stringent. They always ask questions that how come this company was doing 1 crore profit, and then it started doing 8 crore profit, then it started doing 14 crore profit. And in our due diligence which SEBI is doing, in one of the case they asked that, okay, you tell us from which vertical of the company these profits are coming, you quantify it. Then after quantifying, you start giving us invoices of, like, they took 80 invoices in a recent deal. We had to support it by 80 invoices that yes, this profit is coming from there. So SEBI has become so stringent.
But that's an interesting point. Just to add one thing, which you mentioned, that there are about over 90% SMEs that are currently in India, right? Most of them don't pay a tax, right? So I mean that's a very interesting piece of information for these students also, and for me also actually. I mean, it's like if over 90% of the SMEs don't pay tax, and they do it intentionally, not to so to avoid the tax, and then suddenly they jump into the, if they jump into the IPO side, they immediately show the profits out of it. So don't you think, I mean, these things, I mean, one side is I wanted to comply the SEBI rules, but the other side is that when I do SME IPO, um, uh, the moment I wanted to get into the IPO, if I am putting it all across in the marketing or into the words of the retail investors, they also wanted to know that if the company is not making profit, how will they invest? How does that ecosystem work? So one company not making profits, going for an IPO, not showing any profits, and still retail investor is trusting in buying the IPO. What is this psyche? And after this, I probably go to the students also. They might also be having some questions. But yeah.
Well, the thing is that anybody who wants to take his company to an IPO, they have to prepare for minimum 2 years. Uh, if not 2 years, minimum 1.5 years. So they have to start making all the processes, systems, so that they meet all compliances. Paperwork is there for everything, because it takes 4 to 5 months to file a draft red herring prospectus with SEBI. And after they clear it, you file a red herring prospectus. And after that, they take 4 months, 5 months nowadays to clear it. So the regulatory process is now, including the DRHP, it is 10 to 11 months. And you have to be very, very clear that uh, instead of 1 crore profit, if you are showing 5 crore profit, so you are giving a tax of 1.5 crore extra. So you should always remember that your valuation is in multiples of net profit. So if you are giving 1.5 crore extra here, on the other side, instead of a 10 crore valuation, you are getting 50 crore valuation. So you are getting a benefit of 40 crores. So this is what I tell all the SME founders: stop running after making money by tax cheating. That you should have always show proper profit, and that will help you in IPO. And the culture of the company, there is a culture of the company, like this company always follows the all the legal things that gets set properly. All the departments will report proper stuff, and the management will have a better view of what is happening in the company. And so this is what I tell. Although, like, everybody knows that they save on taxes, SMEs save on taxes, but the income tax department is also very, very clever. They they know very well that last year this company showed a tax of a profit of 50 lakhs. So how come this profit has fallen this year? So all nowadays after Modi government, like things are really not so simple. You have to follow the law in maximum the way you can with the limited resources which SMEs have.
Uh, Okay, so over to the students. If you have any questions about the SME IPO, about SME, about even IPO also, right? Because an investment banker is not just serving the startup founders. They actually serve companies, right? So the company could be a startup or could be a traditional company, like a manufacturing company or any other. So as an investment banker, we should all know, what are the different ways of raising the fund, what are the different stages that a company can come to me and asking for any sort of a support in raising the fund or compliance or anything into it. So yeah, over to you, guys. If you have any questions to want to know something, ask the question.
So hi sir, thank you first of all. So we were talking about like how to decide if the company should go for an IPO or like it should go for a venture fund or like next series of fund. So like I like still am unclear about it. Like can you like please enlighten more about it? Like when or how do you decide if we can go for another seed round funds or like we can go for an SME IPO?
See, the VC fund guy has more patience because his fund tenure is 8 to 10 years, and if you are taking larger amounts from a large institution, then their capacity to stay invested is much more. In case of IPO, you get a number of retail investors, and you start getting watched by those retail investors. So what happens is if you are continuously making losses, they will give up on you and the stock will fall. And a stock which gives a loss to the retail investor, his whole family never forgets that stock.
Okay.
But in terms of raising money from venture capitalists, they are more patient. Like in Paytm, you find elevation since so many years. And then in OpenAI, SpaceX, you have investors who are just not bothered with the exit. They are just sitting because they know the valuation will just keep on jumping. And this is what happened with Uber also. Uber had raised money from practically every celebrity in the US, but its valuation always kept on going up. So they never bothered to do an IPO. And finally, at I think 40, 50 billion-dollar valuation, they did the IPO because all those people, some of them wanted exit. So in case you are building something for the long term and you feel that there is likely to be more losses, then you should adopt the VC route. But in case you have a vision that this company I can turn around, like Zomato, after listing, it was having a lot of losses. But when the retail investors they started putting pressure that the company should do a profit. Now Zomato reports a profit, and they are charging for practically everything on the app. And something which cost 300 $350 in the restaurant, they are charging 700 in terms of this fee, that fee. But people are liking it and people are using it. So who am I to say that it is wrong? Like people want this service, so they are paying for it, and the company has become profitable and the stock has gone to the highs. There is another aspect to it, I'll tell you, like the company Oriana Power. Uh, Oriana Power.
Okay.
So it is a rooftop solar company. And in India, the rooftop solar is booming right now. So they did an IPO at 118 rupees and they got listed at 1800 rupees. And then the stock went to 3000 rupees.
Okay.
So now all those retail investors who have earned a profit from Oriana Power, they are backing the share.
Yeah.
And now Oriana Power valuation is so much that just by giving 3% or 4% in a follow-on public offer, it can raise 300 to 400 crores.
Okay.
So if you perform well after listing, you can raise huge amount of money with diluting very small shareholding. That is the beauty of the IPO. That your valuations go crazy. I mean, it is like here you are getting 10 times net profit. There you might get 25 to 50 times net profit after listing. And one more, like Byju's, it was a $22 billion company and it had venture capital, but the company was not doing well, and there was a lot of negative news and lot of controversy because they had not filed the audited accounts. So the company of a $22 billion valuation folded in 4 months. If this company was listed, even if their share had gone down, they could have done a rights issue and raised a small amount of money from the shareholders. Then they could have sold one of their subsidiaries and they get enough cash, and then they could have restarted again. But because their shareholders were all private, they were not able to raise money.
Correct.
I hope
Thanks.
I answered your question.
Yes, sir. Yes, sir. Sir, I also had one more question. Like you were talking about red herring process. So, like I wanted to know like more about it. Like where should I search from? Or like
So if you go to the SEBI and the exchange website, all the red herring prospectus and the red herring prospectus are freely available there. And if you download a red herring prospectus, it is around 500 to 600 pages. It has the entire history of the company right from when it got incorporated, all the things about the founder and the management, all the risk associated, all the legal cases, all the customers of the company, all the financials of the company. It has market section also. What is the market size? Why they are raising this fund? How will they use this money? It has everything.
okay, got it.
And shareholders who put in money in a IPO, it is always said that they should read the entire RHP and then decide whether to put money in this or not.
I have a question. Like you said that SMEs should show profit so that they can get more valuation and it will be beneficial for the VC funding. I believe what I am thinking is that the VC funding people who are funding knows that 97% of them are not showing profit, but they have actual profit. A lot of them would have actual profit and have potential in business. So knowing that 97% of people are doing this, they must be going through and looking at that company in a way, in that way only to check the potential only, not just taking decision on the basis of real profit in the accounts.
So what
So,
happens is that they know that what is the profit which is in audited financials, and the promoter tells them that this is the real profit. So they say, okay, let's do one thing. Let's wait for a quarter. Till that time, we are doing a due diligence on your company. You report the actual profit of this quarter. So they start pressurizing the company to come clean on all the financials. And because they are doing a due diligence, they get to know the inside story, each and everything. That what is the promoter doing? And many promoters, apart from underreporting profit to save on tax, they create structures. They create a subsidiary, they create a proprietorship firm, then they have related party transactions, and money flows from one company to another company. So there are all kinds of promoters. But when a investment banker is working on an IPO case, within 3 to 4 months, he gets to know the character of the founder. And once he gets to know the founder, if the founder is not right, they will generally back out, because if they do a IPO in which they make a loss for the investor, it is a bad name for the merchant banker also in the market. That this merchant banker doesn't know how to do valuation, and this merchant banker made a loss for the investors. So every banker wants that they do an IPO in which on the listing everybody benefits, because in the SME IPO 70% of the retail investors who got the shares in IPO, they start selling on day one because they want to make a profit. So that is why, if your financials of the company are not good and the founder is not genuine, then the merchant banker will have a bad name, because the shares will give a loss to a large number of investors. So, what I'm trying to say is that they know that underreporting in profit was there, but they correct it. They say if you want to go to the IPO route, you have to correct it, because we can't give you the valuation if you don't show proper profit. It is there. And no merchant banker wants to get the license cancelled. SEBI will just cancel the license. So all these companies which you are seeing in the IPO, they are showing proper profit, which is the genuine profit.
Yes, sir. And sir, for the VC funding stage also, uh, like
The
in IPO,
VC
I
doesn't mind
understand.
losses if the losses are genuine. Suppose you are selling some item which you are selling at 20% discount to your competitor. Now the VC will ask you the strategy about it. Why are you doing this? Then you tell him that we are saving the data of uh, this customer, and we will target the customer again with performance marketing, and then sell him a higher value item at a much better profit. So in a way, you are giving your strategy as to how you will make the profit for, LTV to CAC ratio, long term value to customer acquisition cost ratio. How will you make it good? But if you are just uh, like many startups, you're just selling the product at 50% discount just to generate revenue, then the VC will not back you. He's not a fool. So there has to be a thought out strategy behind it. Like Zomato, I really liked that they captured a huge mind space of people. Everybody has Zomato on the app, and they use the service, and at the same time they are now profitable. Like, it is such a rare thing and such a difficult thing. Swiggy has not been able to do it. So it is not easy. Like Paytm, it is struggling since many years to generate a profit. A lot of these companies in Shark Tank, the sharks who are there, their companies are in losses. Like even Oyo reported a profit. I think they let go of many people to save on the employee cost so that they can generate a profit, so that they can do an IPO at a $3.5 $4 billion valuation. So this is what it is.
Okay, we can have one more question. It's already 6:18. We've taken too much of time of Tushar today. Guys, if you have one more question, we can have it, or we can wrap up the session.
Sir, I want to ask one question. Just want to clear one more thing. Like in the starting, you mentioned some kind of debt fund which SMEs in India don't get. So, like, what was that?
Actually, what happens is, if you go to Y Combinator, there you do a 10-minute meeting. So there they give you a very simple agreement, safe agreement. And the agreement has one clause. If you are able to return this money within 1 year, you can treat it as debt and just pay some interest and return the money. But in India, you have grants. Madhur bhai can get you 20 lakhs to 50 lakhs easily as a grant. But when you talk about debt, then no formal channel like bank or NBFC will not give you debt. unless you have incorporation of minimum 3 years. You should be incorporated minimum 3 years. Then they start giving you unsecured debt, and the banks are so wary of giving unsecured debt. They will give you 20 to 30, 35, 40 lakhs, not more than that. And so the debt scenario is pretty bad, and the interest rate in India is very high, like 9 to 12% on secured debt, and unsecured like 14 to 20%. In the US, you are operating as a startup, and suppose you get debt, you pay 4% per year. It used to be 2%, now it is 4 to 5%. In China, it is 3 to 4%. In Japan, it is 1%. You take debt and pay 1% at the end of the year. What else do you want? Free money. So here the debt is very expensive, and the reason for that is traditionally the government has been socialist. So they wanted to do the entire business. So they took the entire public money, used it in loss making companies. So historically, all that debt is sitting on government books, and now they have to take a lot of money from the market to keep these companies alive and keep the old debt alive and everything. So that is why very less money is left for the people, for the private companies.
Sir,
That
startups easily get unsecured debts. But when you compare SMEs and startups, SMEs are more secure than startups, and startups get easily unsecured loans. Then why is it something like that?
no, SMEs get loans easily. They get unsecured loan, working capital loan, term loan. They get CC limits. They get in case you have foreign invoice, you can get the bill discounting. You can generate ECB also, external commercial borrowing, dollar debt. But those rules are very strict. RBI rules for dollar debt is very strict. So that is there. But startups, they have to be minimum 3 years incorporated. Then they should have enough cash flows to service the debt. And then, unsecured, anybody will give you small amount only. I recently got a company in Noida, 3.4 crore of unsecured debt. That was from three NBFCs. And the good part about the company was it was 14 crore turnover, and they never saved tax by showing less profit. So they had a 2 crore net profit on the audited, and the previous year's proper profits. So the bank said this company can easily service my debt, and it was a debt free company. So that is why everybody gave them debt, unsecured debt. 3.4 crore unsecured debt at 16%, uh, which is not easy to repay back, but the company really needed it for the tenders, government tenders.
But it's very interesting to know there are several different ways of raising the funds. It's not just that that I go for a venture debt, venture capital, or an IPO. I mean, there are other ways of raising the fund from international institutions also. I mean, through the bonds or through different modes. I mean, that's very probably we can have another session for that. What are the other ways of raising the fund for as a company or as a startup? That could be really interesting to know. As an investment banker, should have this kind of information when we are interacting with a company. Suggest them what are the best ways of raising the capital, not just by a couple of things which are very generic and everybody knows about it. But that's very interesting. So
The Indian bond market is very shallow. It is when you are AAA rated, you get all the money. Reliance will get 3 billion, 2 billion, 5 billion. When you talk about any company which is AA rated, nobody puts money.
right.
So, but the US is Japan, US, Europe. There, the bond route is open. You are absolutely right. It is, and in Dubai also, like Madhur has a lot of experience in the Dubai area, and he knows so many good sources of funding, including equity and debt. So you guys can approach him separately. He can really guide you.
We will even do a session on masala bonds sometime, because that's a very that's a very interesting
Sukuk bonds and masala bonds.
Yes. We'll do that. So thank you very much, Tushar, for giving us so much of a time. We were supposed to do a
Pleasure.
half-an-hour session, and it's almost an hour that we are tracking. Um, so
Thank you.
looking forward for more sessions also,
Sure.
with you on different topics that you expert into it. And thank you very much, guys. Also, if you have any more questions,
Thank you,
can
everyone.
put in the group, and or you can connect with Tushar over the LinkedIn.
Looking to get added on LinkedIn of all of you. You can search my name there, Tushar Kansal. Thank you,
The
guys.
second bond
Thank
which you
you.
mentioned,
Thanks, Nikita.
sir,
Sorry.
masala bond, and the second one which you mentioned,
Sukuk bonds.
bond. Okay.
Sukuk bonds. If you working in the Middle East in a bank, you will get to know this term. Okay. Thank you, Madhur.
All right. Thank you very much.
Everyone.
Thank you, Tushar.
Thanks.
Everybody.
Thank you, Nikita. Thank you.
Thank you, sir.
Yeah, okay. Thank you, sir.